Yes, boys. So today we're going to be going over a very powerful concept within institutional trading, and that is order blocks. Now, order blocks they represent areas where major financial institutions place their orders, creating them zones of liquidity that the market will often respect them. Now, so today we're going to be breaking down these order blocks and what they are and how to identify them and also how to trade them effectively. So, an order block is essentially the last bullish or bearish candle before a strong move in the opposite direction. Now, these zones indicate areas where banks and institutions have placed significant buy or sell orders, and then often price will return to these order blocks before continuing in the intended direction that the order block is. So, as you can see here, we've got a couple of examples. We've got a bullish order block here where you've got that last candle before a strong move up that created a small breaker structure left behind that fair value gap. That is also what you're looking for, a small breaker structure and a fair value gap as well, and also a small consolidation phase. They're the three things you want to look for to make that order block valid. So as you can see, price then gave us that order block, and then not only a while after that, it then ended up coming back into this order block, respecting it and coming back up, and that is your bullish one. And then you've also got a bearish one right here where price does the exact same. It creates this order block, comes back up eventually, and then keeps coming back down after filling this order block. Now, there's two types of order blocks, as you know. You've got a bullish and a bearish. A bullish order block will form at the sort of the end of a downtrend, and then, or even a retracement, and that will signal that institutions have accumulated a lot of buy orders, which pushes price higher up from that order block. And then a bearish order block is pretty much the same, but for sell orders. Now, one key characteristic of a valid order block is a strong move away from the zone. So you're looking for a very impulsive sell-off or a very impulsive move upwards. You just need a very strong move to make that order block valid. So if price was to sort of do what it does here, rapidly sort of escapes from that order block, like a big candle here, big engulfing candle here, same here, an engulfing candle here, you're looking for a very strong move off of that last candle that obviously creates that three-step criteria: breaker structure, your fair value gap, and after a small consolidation phase. Consolidation phase isn't, however, ultimately necessary. It's just something that will make the zone sort of more valid, if you could say that. Now, to trade order blocks effectively, you want to wait for price to come back and return to these zones and then show signs of a rejection, because as you know, there's things called breaker blocks, which is when an order block becomes invalid because it doesn't get respected. So that's why you got to wait for that confirmation. So you don't want to just be entering off the tap of this order block, which obviously if you were to do in this scenario would have worked, yes, but you want to make sure you're getting confirmation and also a lot of confluences to use within that order block. So let's say we took this bearish order block for an example. We're looking at the hourly chart. If we were to scroll down to the 5 minute or the 1 minute or whatever time frame, within this 1 hour order block, you're probably going to find a smaller, like a fair value gap or something within that, or even a 5 minute order block within this hourly order block that could actually give you that better entry. And this could be exactly where price has come up to and then respected and then come down from there. So that is what you should be looking for. You should be looking for multiple confluences, and then also look for candle confirmation, look for candlestick patterns, look for sort of any engulfing candles that you might see to give you that sort of confidence that price is going to be reversing from that order block. So let's say we were to enter here. You want to be having your take profit at your most recent swing low. So in this instance, this was our swing low before price come back up to the order block. That is where your take profit would be, and then obviously your stop loss just above that order block, which this trade would have given you a 3.8 risk to reward ratio. So yeah, risk management is just so crucial when sort of trading order blocks. You need to make sure you have them stop losses just above that order block, or even if you want to play it more safe, have it above sort of a swing high or something. It will reduce your risk to reward ratio quite a bit, but that is why I say just have them above that order block, because if the order block does become invalid, you could then look for a sort of breaker block entry where you want to be looking for. So if price was to, in this instance, not respect this and it was to just break through, you want to be looking for the retest of that breaker block. So yeah, that is how you trade order blocks, what they are and how to identify them. If this has helped you out in any sort of way, be sure to like, subscribe, and I will see you in the next one.